An entity, seller lessee, sells a building to another entity, which is the buyer who will later on become a lessor, for cash of rupees 30 lakhs. Immediately before the transaction, the building is carried at a cost of rupees 15 lakhs. At the same time, seller lessee enters into a contract with buyer lessor for the right to use the building for 20 years with annual payments of rupees 2 lakhs payable at the end of each year. The terms and conditions of the transaction are such that the transfer of the building by the seller lessee satisfies the requirements for determining when a performance obligation is satisfied in Ind AS 115, revenue from contracts with customers. We know that one of the questions that needs to be asked whenever there is a sale and leaseback transaction is whether a transfer is taking place. And whether a transfer is taking place or not, or whether control is getting transferred or not, that is decided by Ind AS 115. The fair value of the building at the date of the sale is 27 lakhs. Okay, now certain figures need to be understood. In the first para, they are saying that we are selling a building for rupees 30 lakhs. So we are selling the building for rupees 30 lakhs. That's the information. And then they say cost is 15. And now they are saying that the fair value of the building is 27. So sales first they are saying is 30 lakhs. Later on they are clarifying that no, the fair value is 27 lakhs. Remember, under Ind AS 116, if there is a sale and leaseback transaction, the sale should be recorded at the fair value. So we are getting a difference of 3 lakhs of rupees over here. So what we will do is, the sales which is 30 lakhs, you will have to reduce it by 3 lakhs. So your sales value, which is 30 right now, I'll reduce it by 3. So sales will be recorded at 27. And this extra 3 lakhs which is there, that will be understood as additional financing. Right? I'll say it is the additional financing over here. Okay. They are also saying that the cost is 15 lakhs of rupees over here. So fair value is 27. Cost, or you can say the carrying amount also, it is turning out to be 15. That means the total gain, okay, the total gain over here is 12 lakhs of rupees. Of course, the total gain cannot be recognized because the asset will be sold and then the asset will also be reacquired on lease. What I will reacquire, that will become an ROU asset in my books. To that extent, I cannot recognize the gain. But for the rights which I have already transferred, I will be able to recognize a gain. But right now, we are just trying to get a holistic view of the figures. And this is what we realize. Sales will not be 30. It will be the fair value 27. Extra 3 lakhs is nothing but your additional finance, which you are receiving from the buyer lessor. Then they say initial direct cost, if any, are to be ignored. The interest rate implicit in the lease is 12%, readily determinable. Okay. The buyer lessor classifies the lease of the building as an operating lease. Okay. How should the said transaction be accounted by the seller lessee and the buyer lessor? Accounting for buyer lessor is quite simple. How will it be done by the seller lessee? Okay. We say treatment of sale and leaseback transaction. Sale and leaseback transaction under Ind AS 116, isn't it? In books of seller lessee. Step 1. Building is sold for rupees 30 lakhs. at its fair value is rupees 27 lakhs. Right, the first step is that we should recognize the sales value at the fair value. So that's what we will say. Sales value is recognized at fair value. Stop. Thus, sales value is reduced by rupees 3 lakhs. What is that 3 lakhs? It is 30 minus 27 and is considered as additional finance received from buyer lessor. We will reduce the sales value by 3 lakhs of rupees and we will consider 3 lakhs as additional finance that we have received from the lessor. If you're still writing this step, you can just pause the video here. Let's move further. What is the lease rent that we have agreed for? What's the annual payments? They are saying annual payments is 2 lakhs and 20 years and 12%. Okay. This will give us the financial liability. So I'll apply the second step now. Measurement of financial liability. Okay. You'll say here, instead of lease payments, let's use the word total payment. Carry out the working. %, 20 years cumulative. $7.47. $14,94,000. Step 3. Segregation of total payments. If you are still writing, just pause the video here and complete. See, our asset was having a fair value of 27 lakhs, but we sold it for 30 lakhs. So we are suggested that 3 lakhs is the extra money that we have received. So when you are paying 2 lakhs of rupees every year, a certain portion is agreed towards the asset, but a certain portion is also towards the financing requirement. So how much is for the financing requirement and how much is for the asset, that needs to be calculated. Because what we are paying for the asset, that will turn out to be the exclusive lease liability. So we will do a segregation of the total payments. 2 lakhs is what we are going to pay every year. We say towards financing component. This is what we want to calculate first, that how much is towards the financing component. The way I will get it is, we say let the amount be some figure X. Okay. Then for 20 years you are paying this X. See, at 12% we have to do discounting. We have already calculated it is 7.47. So it will turn out to be 7.4x. But we know that the total payment that is to be made towards the financing is 3 lakhs of rupees. So I will argue implies 7.4x is nothing but 3 lakhs. So you are getting additional finance for 3 lakhs of rupees. So on that 3 lakhs you will be charging interest. So along with the interest and all, it will turn out to be 7.4x, 7.47x. So I just want to know what is the amount of x. So 3 lakhs should be divided by 7.47. I get 40,160. 20 payments of 40,160 at an interest rate of 12% will help you to repay the additional finance of 3 lakhs of rupees over the period of 20 years. Okay. So how much is towards the lease? So we say towards lease. This is one, this is another. Towards lease. So this will turn out to be the balancing figure. Okay, this is the balancing figure. So what is the balancing figure? 2 lakhs minus 40,160. How much is that? It's 1,59,840. I hope you are comfortable with this working. Every year you are supposed to pay 2 lakhs. Certain portion is for the additional finance. We argue that that portion is X. So discounting X at 12%, 20 years, we get 7.47X. The 7.47X will represent extra 3 lakhs that is needed to be repaid. So I realize that it is 40,160. So out of 2 lakhs, 40,160 is towards the financing. That means the balance 1,59,840 is towards the asset. This 159,840 will give us the exclusive lease liability. So I'll continue further over here. I will say exclusive lease liability. Why exclusive lease liability? Because this you are paying only for the asset. Exclusive lease liability is again 1 to 20, 159,840, 12% over here, which is 7.47. So I'm getting some 11,94,005. Let me round it off to 11,94,000. So exclusive lease liability is 11,94,000. If you are still solving this, just pause the video here. So step 4 is recognizing the ROU asset now. Step 4, measurement of ROU asset to the extent rights are retained. To the extent rights are retained. And we know that the cost of the ROU asset will be recognized with reference to the exclusive lease liability. So say cost of ROU asset will be equal to exclusive lease liability into cost or carrying amount. They've given cost here, fine, divided by fair value. Exclusive lease liability is 11,94,000. Cost in our example is 15 lakhs. Fair value is 27 lakhs. Solve this. 11,94,000 into 15 divided by 27 is 6,63,333. 6,63,333. That's your ROU asset. The final step now, step 5. Recognition of gain / loss for rights transferred. For rights transferred. We have understood that the total gain basically is 12 lakhs over here. Put it down. We say total gain, that will be fair value minus cost. So 27 lakhs minus 15 lakhs. So total gain has turned out to be 12 lakhs. Entire gain cannot be recognized. However, entire gain cannot be recognized because all rights are not transferred. Stop. So we say gain for rights transferred will be equal to total gain minus exclusive lease liability into total gain divided by fair value. So the total gain we know is 12 lakhs. The exclusive lease liability is 11,94,000. Again, the total gain is 12 and fair value is 27. So 1194 into 12 by 27. This I will like to deduct from 12 lakhs. I am getting 6,69,000 triple. See what I'm writing in this brackets, okay? What I'm writing in the brackets is basically gain for rights retained. It's gain for rights retained and hence cannot be recognized. What you are retaining, how can you recognize gain on it? That's the reason we are finding out that what is the gain on the rights retained and deducting it from the total gain, because whatever is the balancing figure, that will become the gain for rights transferred, which is 669,333. Needless to say, pause the video if you're still writing. So in a way, this is giving us the accounting entry now. And it's time to record the accounting entry. You are selling the asset for 30 lakhs. So the total cash that you are going to receive will turn out to be 30 lakhs. So we say bank account debit 30 lakhs. ROU asset which we are planning to record. Where is it? The ROU asset, some 6 lakhs something. Yes, 663. I'll just fit the figure in my calculator. 663333. Okay. So ROU asset account debit 6,63,333. 2. There is a building in your books which needs to be derecognized. So 2, building account 15 lakhs. There's a liability to be recognized. So we say to financial liability. Here I will not recognize simply the exclusive lease liability, the entire liability, which we know is some 14 lakhs 94,000. 2, gain on rights transferred account, or you can say it is profit and loss account, which we just calculated 6 lakhs, was it 6 lakhs 69 something, right? Yes, 6 lakhs 69,333. 6 lakhs 69,333. Let's check whether the accounting entry is telling. Yeah, it is. So that's the accounting entry in the books of the seller lessee. Pause the video if you are still writing. And if you return back to the question, they are saying how should the said transaction be accounted by the seller lessee and the buyer lessor. Okay. So we say 2 in books of buyer lessor. Here asset should be recognized at fair value and cash paid at sales value. So we record the accounting entry. We will record the accounting entry. We'll say building account debit at the fair value, so 27 lakhs. To bank account, we are making a payment for it at the sales value, which is 30. And the difference between the two is a receivable. So I will say financial asset account debit 3. This 3 lakhs is nothing but the additional finance that you have provided. Okay, this 3 lakhs is nothing but 20 receipts of rupees 40,160. 40,160, right? That third step. How much is for it? Yes, 40,160. 20 receipts. It is basically representing 20 receipts of rupees 40,160 at an interest rate of 12% per annum. Right, that's how we are going to recover this 3 lakhs of rupees. Just pause the video and complete it. It's the end of this question.